Good evening, all of you. Please come to this wonderful chapter AS-11. AS-11 has three parts. The first part was transactions in foreign currency. That first part we have done. Now, the second part today is foreign operations. Foreign operations means those branches, subsidiary, associate, and joint venture. Branches, associate, subsidiary, and joint venture which are operating outside India. So, foreign operations are branches, subsidiary, joint venture, associates whose activities are conducted outside India from Indian company point of view. And next thing is which we have learned that these foreign operations are of two types. For accounting purpose, foreign operations will be of two types. One is called integral and the second is called non-integral. One is called integral and the second is called non-integral. Is it right? Accounting treatment of integral foreign operation is same as reporting enterprise. Same as reporting enterprise. That means same rules are applicable what you have learned in the last 1 day, 1 or 2 days. But the accounting treatment for non-integral foreign operation is slightly different. Integral operations means they are just the extended arm of the reporting enterprise. They are carrying out the same operation of the reporting enterprise in the foreign country. They are there to promote the business of the reporting enterprise. Like a software company in India, Infosys, may have a subsidiary in USA that is to carry out the business of Infosys India into USA. So many Indian companies this way have set up branches, subsidiary, associate or joint venture so that they can cater to the foreign customers. So they will be called integral operation. But if the objective is just to invest in foreign country, not to participate or operate the day-to-day affairs of that foreign company, then usually such operations are called non-integral operation. Now this standard has given you some guideline to identify what is non-integral foreign operation. So on the screen in your book also paragraph number 7, test for non-integral foreign operation. In short, we will call it NIFO, non-integral foreign operation. And integral foreign operation, we will call it EFO, integral foreign operation. NIFO, non-integral foreign operation. Interesting name, is it right? So let us understand how to identify whether a foreign operation is integral or non-integral. So the theory question here is how to identify whether foreign operation is integral or non-integral. So this is the test for identifying non-integral foreign operation. First thing, the foreign operation, if it has got autonomy, write down there, autonomy means independence in decision making. That means foreign operation can decide for itself. They do not have to listen to the dictates of the parent company or the reporting company. They are free to take their own decision. So they are free to decide from whom to buy. They are free to decide to whom to sell. They are free to decide the pricing policy. They are free to decide marketing strategy. They are free to decide hiring of employees. So if they have all this freedom, so if the foreign operation has all such freedom, it is possible it is a non-integral foreign operation. Second way to identify foreign operation is look at the number of transaction. If the number of transaction is not very high between the reporting company in India, reporting company, AS Foundation, foreign operation, Tesla, okay, there is no transaction between the two or very limited transaction. ASF just purchased one electric car from Tesla recently. Only one car for the entire year. And ASF CFO, Mr. Vinod Kumar Agarwal, he just went one time in the space using their Tesla's space tourism program. These were only two transactions. Means number of transactions are not very high. That was just an example to make you understand that number of transactions if not very high, then the foreign operation is non-integral foreign operation. Is it right? Third is the foreign operation finances mainly from its own operation. So foreign operation, FO means foreign operation, is self-dependent as far as finance is concerned. As far as finance is concerned, foreign operation is self-dependent as far as finance is concerned. They are not dependent on parent company. They are not dependent on parent company for their day-to-day finance. So they will raise finance from their own resources. Fourth uh, way to identify foreign operation is a non-integral is who pay for the cost of labor, material and component. Foreign operation pays for the material, labor and other component in their local currency only. They do not depend on head office for payment for the material, labor and other overheads. So they meet their own expenses from their own currency. They meet their own expenses using their own currency. Fifth one, the foreign operation is allowed to sell in other currencies also. So a foreign operation is in USA, they can sell to US customer in US dollar, they can sell to Canadian customer in Canadian dollar, Australian customer in Australian dollar, European customer in euro, Japanese customer in Japanese yen JPY. So if they have the freedom to sell in any currency they want, they can do it. Another important test of NIFO is cash flows are independent. Cash flow of parent company or head office is not dependent on cash flow of foreign operation. Cash flow of the parent company is not dependent on cash flow of the foreign operation. Normally, if it is integral foreign operation, in integral what happens? The subsidiary or the branch They sell the goods in foreign country and remit the funds to the parent company. So parent company depends a lot on foreign operation when it is integral. In non-integral, the two parties are not dependent on each other for cash flows. One more test of NIFO: sales prices are determined locally. That means the foreign operation is free to decide their prices in their own country. The foreign operation decides at what price the goods or services must be sold in their country. It is not the parent company who dictates the price, it is the foreign operation who decides at what price goods and services will be sold. That is, the price does not respond to changes in exchange rate. So the price is not affected by change in exchange rate. I will give you one rough example to understand. Usually the prices in foreign currency are affected by exchange rate if it is integral. Example, I have to sell my accounts book. Example only. I will give my example, not other example. I have to sell my accounts book in USA. So how do I decide the price? Does anyone know how do I decide the price? Please help me. How do I decide the price? So what I will do, I will calculate the cost in rupees because we will manufacture the book in India. So we will incur the material, labor, overheads in India. Let us say it comes to 500 rupees. The cost of printing one book is 500 rupees, and suppose we add profit margin. Let us say profit margin is 200 rupees. So total comes to 700 rupees. Now case 1, so I want 700 rupees in my pocket. If 700 rupees comes to my pocket, I am happy, I got the required profit margin. Case 1, exchange rate is 80 rupees per dollar. Student will reply, what is the price to be quoted in USD? What is the price to be quoted in USD, United States dollar? USD means dollar, United States dollar. So you will take 700 rupees divide by 80. So the price you need to quote in US dollar, so that after conversion you will get 700 rupees. So I will ask the foreign operation to sell at $8.75. So there the foreign operation will sell at $8.75. He will convert at 80 rupees, send it to me, and I will get 700 rupees. I am happy, I got 200 rupees margin. Case 2. Case 2. Exchange rate is 70 rupees per dollar. Exchange rate is 70 rupees per dollar. At what price these goods will be sold in foreign land? These goods will be sold now in USA. 700 divided by 70 is $10. So now you are right. So can you see in my example, when the exchange rate was 80, the price quoted was 8.75. Tanya is right. When the exchange rate was 70, the price quoted in US dollar is 10. So what do you observe? You observe that the price is responding to change in exchange rate. If the exchange rate is influencing the price, then it is integral foreign operation. Then it is integral foreign operation. But if the price is not influencing, let us say the foreign operation says, I don't care what is the exchange rate, I am going to sell the product at $15. Whatever may be the exchange rate, whether 60, 70 or 80, then it is an non-integral foreign operation. But if the prices keep changing, because the exchange rates are changing, then it is integral foreign operation. And the last point to identify non-integral operation, as per AS-11, there is an active local sales market for its product. So they are producing and selling actively in local market their local products. So they are not dependent on head office or the parent company for selling goods. They can procure, manufacture locally and sell locally also. So that is an example of integral foreign operation. There are total 8 points. Now there is a small problem here. What is the problem? The problem may be, out of 8, some points some points may indicate it is non-integral foreign operation, whereas some points may indicate that it is an integral foreign operation. Not all condition may get satisfied. Not all condition may get satisfied. So they may have the autonomy, but the number of transaction may be too high. Foreign operation has autonomy, first condition satisfied, but the number of transactions are also very high. So looking at first point, it looks like NIFO, but looking at second point, it looks like integral foreign operation. So what this standard says, if you have some points in favor of NIFO and some points in favor of integral foreign operation, the enterprise should apply its judgment. The enterprise should apply its judgment, and the management has to decide whether they want to call that foreign operation as integral or whether they want to call that foreign operation as non-integral. So the student will have to answer some theory question here in the exam. They may give a case study and they may ask you whether this foreign operation is integral or non-integral, and then accordingly you have to read the case study and reply. Okay. Now next is, how will you translate foreign operation into reporting currency? Foreign operations can be branch, foreign operation can be subsidiary, foreign operation can be associate, and foreign operation can be joint venture. Only focus on understanding subsidiary, associate, joint venture. These are separate legal entities. These are separate legal entities. Their financial statements are consolidated. Their financial statements are consolidated with reporting company. But good news for you, consolidation is not a part of our syllabus. Consolidation is not a part of syllabus. Hence, enjoy. You will not be asked questions on subsidiary, associate, and joint venture. Enjoy. Dance. Okay. So everybody stand up at your home and dance, because you will not be given question on subsidiary, associate, and joint venture. However, branch is a part of your syllabus. There is a chapter also called foreign branch. Foreign branch means a branch outside India. And when you will solve the question of foreign branches, you will have to first check whether it is integral foreign branch or non-integral foreign branch. Integral foreign branch, you will be given a trial balance. The trial balance will be in foreign currency. You have to convert it into home currency. What will be the methodology of conversion? Same as reporting entity. Whatever rules and regulations I have told you in the previous two lecture, the same will be applied for integral foreign operation. For integral foreign operation, you just apply the same set of rules of conversion which you have applied for the reporting company. Okay. So in your book, next paragraph, there are two tables. First table is for integral foreign operation. I am not going to read the whole table. The answer is simple. For integral foreign operation, convert the transaction using the same rule which you apply for reporting enterprise. Convert the transaction using same rule which you apply for reporting enterprise. Now I will just read from your book. Some of you want me to read. So you see there is a table which says cost and depreciation of tangible fixed asset, date of purchase, asset which are carried at fair value, date on which fair value is determined, cost of inventory, date on which such costs were incurred, assets that are shown at realizable value or recoverable amount, date on which such value was determined, contingent liability, closing rate, and resulting exchange difference recognized in the statement of profit or loss. So you will find that same rules you have applied for the reporting company also. Where is the difference? The difference is in translating the financial statement of a non-integral foreign operation. The difference is in translating the financial statement of a non-integral foreign operation. So just quickly I will revise integral one more time. In case of integral, listen to me, when you enter into a transaction, either you apply rate of exchange on the date of transaction or average rate. Okay. Then monetary items you apply closing rate. Non monetary items under that A carried at cost model, please reply, this is multiplied using historical rate, and if it is carried at fair value or maybe realizable value or maybe revalued amount, then we apply the rate, date of determination of fair value, date of determination of fair value, revalued amount, realizable value, the date we determine. And the next point to be remembered is if there is exchange difference, that exchange difference is transferred to P&L account. Do you remember the same set of rules we have applied in many questions solved? Same set of rule will apply for integral foreign operation. Same set of rule will apply for integral foreign operation. Good student will write at least something. Now non-integral, good news. All assets and liabilities. Pay attention, I am going to take a question on this soon. All assets and liabilities at closing rate, whether monetary or non-monetary. So one good thing is here, whether it is a monetary asset non-monetary asset, monetary liability, non-monetary liability, all of them will be translated using the closing rate. And income and expense at respective rate on the date of transaction. Income and expense on the respective rate on the date of transaction. Income and expense, whatever is the date you will take. Okay, or you can take average rate. It's written in your book. In that small table, it is written in the book. Or average rate can be used. And then there will be a difference. Now, this is an important point. Two important points are there. First important point is that monetary and non-monetary asset and liabilities will be converted at closing rate. And the second important difference is the exchange difference which will arise will be transferred to foreign currency translation reserve. Will be transferred to foreign currency translation reserve till disposal. So we are not going to transfer it to P&L account immediately. Not to P&L account immediately. Rather, we are going to accumulate in foreign currency translation reserve, and we are going to transfer it to P&L account when that foreign operation will be disposed. Disposed means sold, okay, or removed. Next point, goodwill or capital reserve. Now this will arise when you are consolidating a subsidiary. But as I said, consolidation is not a part of your syllabus. Still, because it is written in the standard, I have to tell you, if you are consolidating a subsidiary, and if when you are consolidating a subsidiary, it will give rise to either goodwill or capital reserve. This standard says if goodwill or capital reserve arise on the acquisition of non-integral foreign operation, that goodwill or capital reserve will be converted at closing rate. Will be converted at closing rate. Closing rate means balance sheet date rate. But you don't have to apply this in your question. The reason being, in your current syllabus, consolidation is not there. So unless you learn consolidation, you will not be able to understand the goodwill or capital reserve arising on acquisition. So do not worry, they will not ask you any question. And you will find that there are no question on subsidiary in your notes. Now next is disposal. Disposal of non-integral foreign operation. First of all, any query till now? Any query till now? Otherwise, we will go ahead. So please tell me, do you have any query? Yes or no? Everybody, try. No query? If you don't have query, then we will be forced to go ahead. So once NIFO is disposed, the balance lying in FCTR will also be transferred to P&L account, because now that NIFO is not there, so the FCTR balance will also not be there the same year in which NIFO is disposed. Okay, if NIFO is partially disposed means, let us say only 50% shares sold, So what I will do, I will only transfer 50% of FCTR to P&L account we will transfer. 50% of FCTR we will transfer to P&L account. So in case of partial disposal, if suppose the balance is 200 rupees, I will only transfer 100 rupees from FCTR to P&L account. FCTR means we are a passive investor. The logic is, now you are understanding logic. In FCTR or in non-integral, we are a passive investor. So we recognize the gain due to exchange fluctuation only when the investments are sold. Till the time investments are not sold, we do not route it through P&L account, rather we accumulate in FCTR. Once it is sold, profit is realized, and now I am free to transfer it to P&L account. So that is why in case of non-integral foreign operation, they are not allowing you to transfer the exchange difference to P&L account immediately. They will allow you to transfer only on disposal. Okay. So disposal of a foreign operation can take place in the following manner: generally by sale, or when the foreign operation itself is liquidated, that company is closed down, or repayment of share capital. That means that foreign companies goes for buyback of share capital, or abandonment. Abandonment means left. Suppose you have a subsidiary in Afghanistan. Afghanistan is a peace loving country, and you have a factory there, okay, which is your branch. What will you do? Will you go and do business there, or will you just simply leave it and run away? Quickly answer. Will you go and operate your factory in Afghanistan, which is near Taliban headquarter, or will you leave it and run away and take a flight and come back to India? So what is your response? So the answer is, our life is more important than factory and investment, so we will abandon it, and therefore it is assumed to be disposed. Abandoned is also disposed. Sometime we may have to write down an investment. Write down means, suppose the carrying amount is 1 lakh rupees, the value of the investment has gone down. Value of the investment has gone down by 5,000 rupees due to market fluctuation. So I will write off 5% of it. Write off is not equal to disposal. Write off is not equal to disposal. Ganesh Gupta is saying, I will quickly run away. You are right. Your life is important. Otherwise, Taliban don't give you second chance. Okay. You will get a bullet if you don't run away. So what I was saying, if you reduce the carrying amount of the investment by some percentage, it is not partial disposal. In that case, since it is not partial disposal, you are not going to transfer from FCTR to P&L account. Okay. So write down of a carrying amount is not a partial disposal. So you will no need to transfer to P&L account. So this is the instruction about non-integral foreign operation. So I will just revise what we have done today. Foreign operations are of two types: integral, non-integral. Integral operations are those which are extended arm of the reporting enterprise only. They are operating in the foreign country to promote the business of the reporting enterprise. So the rule of conversion is same for integral operation what is applicable to the reporting enterprise. That is, transactions will be recorded at actual rate or average rate, monetary items at closing rate, non-monetary item which are carried at historical cost at historical rate, non-monetary item which are carried at fair value, rate of exchange on the date of fair value determination, and exchange difference is transferred to P&L account. If it is a non-integral foreign operation, transactions will be recorded at average rate or actual rate, monetary and non-monetary, assets and liabilities, both will be measured at closing rate. The difference is transferred to FCTR and balance in FCTR is transferred to P&L account when the foreign operation is disposed. If foreign operation is partially disposed, partial amount will be transferred to P&L account. Write down of foreign investment is not equal to partial disposal. So in case of write down of an investment, no amount will be transferred to profit and loss account. So that was a quick revision of our today's lecture till now. Did you like it? Did you like the quick revision? Now, there can be change. Can a integral foreign operation become a non-integral foreign operation? Can an integral foreign operation convert into non-integral foreign operation? From an active management of foreign operation, I may just become a passive investor. I will decide that no, I will not participate in day-to-day management. It is too much. I don't have time, energy, resource, effort, very time consuming, very headache. So let us just simply become a passive investor, enjoy the dividend, enjoy the capital gain. Yes, possible. Reverse is also possible. Reverse is also possible. A non-integral foreign operation. Earlier I was a passive investor, but then I believe let us become an active investor now. Let us involve ourselves in day to day management, running of the day to day operations of that. Possible. But as an accountant, I will have to make some changes in our books. Okay. So when you are following E4 integral, you had monetary item, you had non-monetary item. Monetary item was at closing rate. Non-monetary items are of two types: cost model, fair value model. Cost model was appearing at historical rate, and fair value usually appears at close rate. And if it is to be converted into NIFO, monetary item in any case it is already at closing rate, so no problem. Last one, non-monetary item which are carried at fair value, they are also usually at closing rate, so no problem, no problem. But visualize this one, non-monetary item which are carried at cost. Earlier we were following historical model, but once it gets converted into NIFO, even the non-monetary item which are carried at cost will be measured at closing rate. So this is one item which will have to be revalued again. This item will have to be revalued again because earlier it was valued using historical rate, now new rate. And second point, earlier when it was an integral operation, the difference was transferred to P&L account. Now it has become non-integral. The difference will be transferred to FCTR. Is it right? So if the student can understand what was done earlier and what has to be done now, then he will understand the accounting treatment also. So there are two important differences between integral and non-integral operation accounting. In integral operation accounting, non-monetary item which are carried at cost is measured at historical rate, whereas in non-integral closing rate, here the difference goes to P&L account, here the difference goes to FCTR. So we are moving from integral to non-integral. So what will be the accounting treatment on the date? What will be the accounting treatment on the date the company is shifting from integral to non-integral for an operation? Is it right? Suppose on 1st November 2022, we have decided to reclassify integral operation to non-integral operation. So what will I do? The non-monetary items, exchange difference on non-monetary asset on the date of reclassification will be accumulated in FCTR. So I have non-monetary item which are carried at historical rate. They will be converted using exchange rate on date of reclassification. They will be converted using exchange rate on the date of reclassification. So today is 1st November. All such non-monetary item which was carried at historical rate will be revalued today at today's rate. Let us say in our books we have a land whose dollar value is 10,000. It was purchased 10 years ago at 56. So its historical rate is 56. It was appearing at 5,60,000. But today, instead of E4, now we say no, this foreign operation will be classified as NIFO. Today the exchange rate 76 rupees per dollar. So I will have to revalue this land. Land account debit. The standard says when you will revalue such non-monetary item, you are going to transfer the difference to FCTR because now it is non-integral foreign operation. So my answer for this question will be 10,000 into difference between 76 minus 56. 20 rupees into 10,000. 2 lakh rupees I will have to transfer to FCTR. What about other items? Other items are already at closing rate, so they won't be affected much. Okay, but this item, that is non-monetary item measured at historical rate, their balance will have to be revised and they will transfer it to FCTR. Second possibility is also there. Second possibility is that non-integral foreign operation. Non-integral means passive investment, not management of day-to-day work, is called non-passive investment. They may decide to reclassify it to integral foreign operation. So what will be the accounting adjustment? When it was NIFO, monetary item closing rate. Non-monetary item carried at cost was also closing rate. Non-monetary item carried at fair value was also at closing rate, and the difference was accumulated in FCTR. This is what we have been doing when the foreign operation was NIFO. Now we want to make it EFO, integral. No change here, no change here, but here there will be a difference. Non-monetary item which are carried at cost. Under NIFO, we were following closing rate. Under EFO, what rate we will follow? That is the guidance given here. First, let us read the guidance given here. Translated amount of non-monetary asset on the date of change, underline on the date of change, are treated as historical cost for those items. Suppose I have a land. Earlier it was NIFO. Now we have shifted to EFO. So what will happen? Whatever is the exchange rate on the date of transaction, that will become historical cost for those items. That will become historical cost for those items. So I will explain it with the help of number. Land was purchased on 1/4/2018 for $10,000. So exchange rate was rupees 70 per dollar. Foreign operation was NIFO. Foreign operation was NIFO. 1/4/19 exchange rate is 71. 1/4/20 exchange rate is 72. 1/4/21 exchange rate is 73. Then on 1st 11/2021, we decided to convert NIFO into integral foreign operation, and now the rate is 74. Today the rate is 74. So what will happen now? This land will be valued at 74 today, and this will become its historical cost for future accounting. This will become historical cost for future accounting because it is to be carried at cost model, and we are going to follow integral foreign operation from future period. Is it right? So you can ask me the question, can I take 70 rupees again? The answer is no. The answer is no. You are going to apply the rate on the date of reclassification. Don't go to the past. Forget the past. What is the rate today? 74. This will become deemed cost. This will become deemed cost for future accounting under integral foreign operation. Then your question will be, what will happen to FCTR? Because earlier it was FCTR, NIFO. Will you transfer? Please reply. When you are converting NIFO to EFO, will you transfer? Will you transfer FCTR balance to P&L account? Only two answers are possible, yes, no. When you are reclassifying foreign operation from non-integral to integral, there must be some balance lying in FCTR. Will you transfer it to P&L account? Will you transfer it to P&L account? I'm waiting for your reply. Will you transfer it to P&L account? Yes or no? Please guess. The answer is no. Reclassification is not equal to disposal. Reclassification is not equal to disposal. It is written in your book also. Exchange difference to accumulate in FCTR till disposal. And those interested student can write here, reclassification is not equal to disposal. So interesting thing is that even though non-integral foreign operation is reclassified into integral, the standard says I will not allow you to transfer from FCTR to P&L account. Let it remain in FCTR only. When you will dispose that foreign operation, that time I will allow you to transfer to P&L account, so that the companies cannot take the advantage of this. Company cannot take the advantage of this. Otherwise, if suppose company want to increase the profit, if company wants to increase the profit, they have some balance in FCTR, they will reclassify for an operation, get the balance transferred to P&L account and increase their profit figure. So the standard says no, nothing doing. We will not let you do that. Right? Now I am going to give you two questions which are not in your book, but which are required for understanding this concept. In one case, I will convert NIFO to EFO, and in another example, I am going to convert EFO to NIFO. How to do accounting when this reclassification will happen? Before that and after that, how the accounting will change? A very good example taken from a reference book only for you, because you seem to be a good student. So please write down the question. This question you will not find in any of the ICAI publication. So please write down ABC Limited, ABC Limited, US subsidiary, US subsidiary of an Indian company, US subsidiary of an Indian company, XYZ Limited, purchased a plot of land, purchased a plot of land. Instead of subsidiary, you can make it branch also. Answer will not change. You can make it branch. Okay. So please try this wonderful question. ABC Limited, US branch of an Indian company XYZ, purchased a plot, purchased a plot of land, purchased a plot of land at USD 1 lakh, purchased a plot of land at USD 1 lakh by taking a loan, by taking a loan on 1st April 2009, by taking a loan on 1st April 2009, by taking a loan on 1st April 2009, assuming that, assuming that there is no repayment of loan, assuming that there is no repayment of the loan by ABC Limited, there is no repayment of the loan by ABC Limited up to 31st March 2012, up to 31st March 2012. There is no repayment of the loan up to this date. So even if the loan is repaid, the land will continue. Yes or no? Even if the loan is repaid, land will continue in the books. Now write down two columns, date column and exchange rate column. Very important question you are solving, because your institute material is not good enough for understanding such situation. To be very frank, you have to learn separately. Date, write down 1st April 2009. Date, write down 1st April 2009. Rupees 45 per dollar. That is the first day when the transaction happened. Then write down 31st March 2010. 31st March 2010, 48. 48. 31st March 11, 46. 31st March 12, 52. 31st March 12, 52. 31st March 2013. 31st March 2013, 55. 45, then 48, 46, 52, 55. This way the rates are going down or up sometimes. Now write down case 1. Case 1. Case 1, write down reclassification of ABC Limited. Reclassification of ABC Limited, an integral foreign operation. In short, you can write IFO to save time. An integral foreign operation to NIFO, non-integral foreign operation, as on 31st March, as on 31st March 2012, as on 31st March 2012, as on 31st March 2012. Then write down case 2. Please keep writing. Case 2, reclassification of ABC Limited. Reclassification of ABC Limited into bracket a non-integral foreign operation, NIFO, into integral foreign operation, into integral foreign operation, into integral foreign operation, as on 31st March 2012, as on 31st March 2012. Once you have finished writing, please tell me. Once you have completed writing the question, tell me. Is it over? Is it over? Have you completed writing the question? So you have said yes. Now I am going to read the problem again for you and explain, and then we will solve together. ABC Limited is a US foreign operation of an Indian company. It has purchased a land for 1 lakh USD and by taking a loan. So why we have given loan? Because land is a monetary item which is usually carried using cost model, whereas loan is a land is a non-monetary item, whereas loan is a monetary item. So in the same question, you will see the effect of both. Okay. Now there are different rates given. In first case, Originally it was E4, now it is NE4. Whereas in case 2, originally it was non-integral, but now it is integral. So please solve by writing case 1, pass journal entry in the books of XYZ Limited at the time of consolidation. So write down pass journal entry in the books of XYZ Limited at the time of consolidation. So don't worry, this won't affect consolidation process. Only we have to pass entries related to this transaction. We are not going to prepare any consolidated financial statement today. So enjoy. Pass journal entry in the books of XYZ Limited at the time of consolidation. So dear student, write down case 1. All of you please write down the heading in bold letters, capital letters, use a different color if you want. Case 1 is reclassification of ABC. Reclassification of ABC. Reclassification of ABC in bracket, just write down from E4 to NE4. From E4 to NE4 on 31st March 2012. On 31st March 2012. Okay, on 31st March 2012. So first we were following E4. Under E4, land will be measured at historical rate only, whereas the loan is a monetary item. So monetary item will be at closing rate. Under E4, land is a non-monetary item. We will use historical rate, and loan is a monetary item. We will use closing rate. But once it becomes NE4, land will also be measured at closing rate. Loan as usual continue to be accounted at closing rate. Okay. So let us write down journal entries. Draw one page. Journal entries, please draw one page. Narration you need not write. Narration can be written as homework later. Narration can be written as homework. So on the first day, let me just take you to the question. Please concentrate on question on the screen. On 1st April, we will purchase a land using borrowed money. Then on 31st March, I am not going to revalue the land. Land I will keep as it is because right now we are following integral foreign operation principle. But the loan is a monetary item and it needs to be revalued at closing rate. So what will happen on 31st March? On 31st March, my land will continue to appear at 1 lakh into 45, but my loan will have to be revised at 48, and this will give rise to an exchange difference of 3 lakh rupees. This will give rise to an exchange difference of 3 lakh because land I am not going to change. I am following integral operation. Loan I will have to change. So please write down journal entry if it is an integral foreign operation. If it is integral foreign operation till 31st March 12, till 31st March 12, it is an integral foreign operation only. Thereafter, it becomes non-integral operation. So land will appear at its cost only. Land account debit 1 lakh into 45 exchange difference account debit 3 lakh, this is balancing figure, to loan account. Loan is a monetary item, so loan will be valued at closing rate. So loan will be valued at closing rate 48 lakh. Loan will be valued at closing rate, okay, 48 lakh. Narration is, if you want to write the narration, write little fast. Being land purchased, being land purchased by ABC Limited, being land purchased by ABC Limited, an exchange difference, an exchange difference charged to P&L account. Now see, right now it is integral. Remember, integral operation is like reporting enterprise only. So exchange difference right now we will transfer to P&L account. Exchange difference right now we will transfer to P&L account, because right now the classification is integral. Integral is as if it is the reporting enterprise only. Now we'll go to year 2. In year 2, you see in your question, the exchange rate has gone down by 2 rupees. From 48, it has become 46. So loan balance, loan account debit 2 lakh. 48 minus 46, 2 rupee is the decrease in exchange rate. So liability will reduce by 2 lakh. Land we are not going to adjust. To exchange difference, to exchange difference in bracket P&L account. To exchange difference in bracket P&L account. To exchange difference in bracket profit and loss account 2 lakh. To exchange difference P&L account 2 lakh. Being exchange fluctuation, being exchange difference transferred to P&L account. Being exchange difference transferred to P&L account. Being exchange difference transferred to profit and loss account. Okay, that was 31st March 11. Now we'll go to 31st March 12. Now we'll go to 31st March 12. Till the end of 31st March 12, the classification was integral. Till the end of 31st March 12, the classification is integral. So we are going to again transfer the difference to P&L account. Now if you look at the exchange rate, it has gone up by 6 rupees. From 46, it has become 52. Oh my God. So your entry will be exchange difference. Exchange difference in bracket P&L account debit. Exchange difference debit 6 lakh. 1 lakh into 6 rupees change in rate to loan account. To loan account 6 lakh. To loan account 6 lakh. Being exchange difference charged to P&L account. Being exchange difference charged to P&L account. But what happened on 31st March 12? On 31st March 12, they decided to reclassify integral foreign operation into non-integral foreign operation. And they have one land in the books which is carried at cost. So new classification, as per the new classification, now the land will also be valued at closing rate. Now the land will also be valued at closing rate because the company has reclassified the foreign operation from integral to non-integral on 31st March 12. So land account debit. Land was originally recorded at 45. Now today on 31st March 12, write down, on 31st March 12, the land needs to be revalued because we have shifted from E4 to NE4. And second thing, now this difference will be transferred to FCTR. Now this difference will be transferred to FCTR, not P&L account, because now from 31st March 12, the classification is NIFO. So please write down the entry with calculation, land account debit to FCTR, foreign currency translation reserve, 7 lakh, to FCTR 7 lakh. Narration write down for future reference, being exchange difference on translation of non-monetary item, exchange difference on translation of non-monetary item, for example land, accumulated in foreign currency translation reserve. Accumulated in FCTR. Okay, so now we have moved to NE4. Now we have come to which territory? Now we are going to follow NE4. Under NE4, all assets and liabilities will be measured at closing rate. So next year again, the rate has gone up. See in your question book or the question dictated to you. The rate has gone up from 52 to 55. Will you revalue the land again? The answer is yes. Question is why? Because now the classification is NIFO. In case of NIFO, all assets and liabilities, monetary or non-monetary, will be valued at closing rate. So my land will again be revalued. Land will again be revalued because now it is NIFO. 3 lakh to FCTR 3 lakh to FCTR 3 lakh. Narration homework, same narration, and now there is a loan also. Now there is a loan also. Even the loan will be revalued, and even in case of loan also, because it is NIFO, all exchange difference we will accumulate in FCTR. So write down foreign currency translation reserve account debit, foreign currency translation reserve account debit to loan account 3 lakh, to loan account 3 lakh, because now whether it is loan or whether it is land, both will be translated at closing rate and both will be transferred to FCTR because the foreign operation is now classified as non-integral foreign operation. One student is asking a query. Land was valued at 45 lakh in EFO. Very good. You are right. What is your query? You are giving me fact. Give me query. And now it is non-integral foreign operation. So it will be valued at closing rate. Closing rate on 31st March 12 was 52. So it will be valued at 52 lakh or 52 million. Closing rate on 31st March 13 is 55. So it will be valued at 52 lakh. So therefore, as you change the classification, the value of the land will also start changing. That is what the standard says. Okay. So this was my case number 1. In case number 1, you can see on the screen, old classification was integral, new classification is non-integral. The effect of that is the day when this reclassification took place, the value of the land also started changing and the difference started getting transferred to FCTR. Now write down, dear student, case 2. Case 2 is reclassification from now this time NIFO to EFO. Reclassification from NIFO to EFO on 31st March 2012. On 31st March 2012. On 31st March 2012. On 31st March 2012. So please pay attention again. When you are following NIFO, land plus loan, both will be revalued at closing rate and the exchange difference will be transferred to FCTR. When you will start following EFO, land will not be revalued further. Only loan will be revalued and the exchange difference in case of loan will be transferred to P&L account. So this is the concept. But students will know the concept. I have to tell you the application in practical life. Day to day life, when you will become a qualified professional and if you will work in office and if you get this situation, you have to actually pass the journal entry. Theory has to be converted into practice and this question exactly does that. So now we will start this question all over again. So heading is NIFO to EFO. First you write down 31st March 2010. First year ending date. First year ending date 31st March 2010. Both land and loan will be valued at closing rate. Both land and loan will be valued at closing rate. So start now, start journal entries. Journal entries. First date column, write down 31st March 2010. 31st March 2010. Please write down. This time the interesting part is land will also be revalued because it is originally classified as NIFO. Original classification was NIFO. So if it is NIFO, all assets, all liabilities will be multiplied by closing rate on the balance sheet date. Land account debit 48 lakh to loan account 48 lakh to loan account 48 lakh. Being land purchased, being land purchased and loan taken by ABC Limited and loan taken by ABC Limited translated on the exchange rate translated on the exchange rate on the date of reporting on the reporting date on the reporting date, that is rupees 48 per USD. So both loan and land will be revalued using closing rate. So this is 31st March 2010. Now write down 31st March 11. 31st March 11. We are going to revalue both land and loan. You can do it together or you can do it separately. So now I am going to record separately. Okay. Now I am going to record separately. So in the second year, what happened? The exchange rate has gone down by 2 rupees. Exchange rate has gone down by 2 rupees from 48 to 46. Entry will be FCTR account debit 2 lakh. FCTR account debit 2 lakh. To save time, you can just write FCTR. To land account 2 lakh. To land account 2 lakh. FCTR account debit 2 lakh to land account 2 lakh. Why 2 lakh? 1 lakh into decline in exchange rate by 2 rupees. Value of land will reduce by 2 rupees. Being land translated on the exchange rate on the reporting date. Land translated using exchange rate on reporting date. And in the same way, third entry, same date, loan will be retranslated. Loan will be retranslated. Loan liability will also reduce by 2 rupees. Loan liability will reduce by 2 rupees. Entry will be loan account debit 2 lakh. Loan will also reduce by 2 rupees from 48. The exchange rate is 46 now. So 2 rupees gain as far as liability is concerned. So entry will be loan to FCTR 2 lakh being loan translated at closing rate. Being loan translated at closing rate. Being loan translated at closing rate. This is 31st March 2011. It is still classified as non-integral. Narration is homework. Then we'll come to 31st March 2012. Till the end of 31st March 2012, till the end of 31st March 2012, the classification was non-integral. So one more time the land will be revalued till the date of reclassification. So date of reclassification is 31st March 12. Today the exchange rate has gone up from 46 to 52. So I will revalue the land by 6 rupees. This 6 rupees is difference between 52 and 46. Okay. So land account debit to FCTR. Land account debit to FCTR 6 lakh. Being land translated on reporting date. Land translated using exchange rate on reporting date. This is the date up to which old classification was there, and after that it will become integral. So as long as it is non-integral, every year end, land will be revalued at closing rate. One more item is there, loan. So write down one more entry, loan. Loan will also increase by 6 rupees per dollar. FCTR account debit, FCTR account debit, FCTR account debit to loan account, FCTR account debit to loan account 6 lakh. 1 lakh into 6. 1 lakh into 6. 1 lakh into 6. So today is the cutoff date. It was NIFO. So difference was transferred to FCTR. Now here the classification is EFO. Henceforth, in case of loan, the difference will be transferred to P&L account. After it will become integral operation, the difference will be transferred to profit and loss account. So entry write down first, FCTR to loan account 6 lakh. This is what we have done. We have given the effect of what was written in the standard, being loan revalued using closing rate. Now the interesting thing is 31st March 2013. From 1/4/12 to 31st March 13, the classification of foreign operation is EFO. Henceforth, land will not be revalued because it is a non-monetary item carried at cost, whereas loan will be revalued. Loan will be revalued because it is a monetary item, and the difference this time will not be transferred to FCTR, but the difference will be transferred to P&L account. So that was very interesting. So now you will write loss on exchange fluctuation account debit 3 lakh, loss on exchange fluctuation account debit 3 lakh to loan account 3 lakh. This time you write down in bracket here P&L account. Logic, it has become integral operation. Being exchange difference credited to debited to write down, being exchange difference debited to P&L account, being exchange difference debited to P&L account, being exchange difference debited to P&L account. Okay, once it becomes EFO, we are going to transfer difference to P&L account. Land will not be revalued. This answer is over. For your understanding, write a note. For your understanding, write a note. Later on, no confusion. Write down, in this case, in this case, on reclassification of, in this case, on reclassification of non-integral foreign operation into integral foreign operation, on reclassification of non-integral foreign operation into integral foreign operation, the translated amount for land on 31st March 12. The translated amount of land on 31st March 12. So on 31st March 12, the value of the land in the books was 52 lakh, and it will remain 52 lakh only. Using the exchange rate of 52 per dollar, using the exchange rate of rupees 52 per dollar, should be treated as should be treated as historical cost for land, should be treated as historical cost for land in the subsequent periods, in the subsequent periods, should be treated as historical cost for land in the subsequent periods. So henceforth, land will appear at 52 lakh only. Loan will be revalued. Difference in exchange rate will be transferred to P&L account. So this is what you have to do when you convert NIFO into EFO. So my answer is over. Today you do one uh, self-reading, para 10 for self-reading. What you have to do in para 10, there is a table which gives you difference between integral foreign operation and non-integral foreign operation, a theory question for 4 marks. Difference between integral and non-integral foreign operation. One student is asking a query, can we pass entry like this? Land account debit 6 lakh, which is 6 lakh. Land account debit 6 lakh to loan account. Loan account how much? Amount you have not mentioned. Incomplete question cannot be answered. Any other way, if you pass the entry, journal entry can be passed in more than one ways. So let us not waste our time. From 11th standard you have studied, journal entry can be passed in more than one way. If the effect is same, if the effect is same, you can do it. If the effect is different, you cannot do it. Ideally, we should pass separate entry for land and separate entry for loan so that you will feel the effect. Otherwise, you will not feel the effect only. You will not know what is happening. Okay? So, shortcut should be avoided. Students are always asking for shortcut. That is why India is a mediocre country and it will remain like this only if you keep on asking such shortcut thing. Now we'll come to question number 1. Exam question based on branch accounting. Only we will learn today how to convert the trial balance of a foreign branch into reporting currency using two methods, integral, non-integral. And in the exam they ask such question for 4 to 8 marks. Very easy bonus marks. Call it bonus mark. AS Foundation, Delhi, wonderful, has a branch in Sydney, Australia. What is the currency of AS Foundation? Rupees, rupees, INR, whatever you call it. And the currency of Australia is Australian dollar. At the end of 31st March 2005, the following ledger balances have been extracted from the books of Sydney office. So this is the trial balance of foreign branch, which is in Australian dollar. We will have to convert into Indian rupees. Plant and machinery cost, depreciation on plant and machinery, debtor, creditor, debit balance is debtor, credit is creditor, this is opening stock, cash bank, purchase sale, this is purchase, this is sale, goods sent to branch, wages and salary, rent, office expense, commission receipt, and balance payable to HO, amount payable to head office, and this is the total. Now below this there is some information given to you. The following information is also available one by one. Goods sent by HO, rupees 1000 to the branch. Branch account in, so wait, first there are two adjustment in this. One is goods sent by head office to branch is rupees 100,000. Head office has sent goods to branch. In the books of head office, rupees 100,000 is appearing. And in the books of branch, let us see in the trial balance what is appearing. Goods sent to branch, here $5 is appearing. These two are same item. HO will send, branch will receive. But HO records in, HO will record in rupees, branch will record in Australian dollar. So can I say this 100,000 is equal to 5 Australian dollar? 100,000 is equal to 5 Australian dollar. Another adjustment is branch account in HO book. Branch account in HO book is 120,000. Branch account in HO book is 120,000. And if you look at the trial balance, the HO current account is $7. Now in this case what I will do, $7 is equal to 120,000 rupees. So when the same figure is appearing in branch account also and HO books also, that is there is a contra effect, I will simply take the figure appearing in HO book and substitute it in the trial balance of the branch. So for these two items which is highlighted on the screen, goods sent to branch and HO account balance, this I will simply substitute the figure of the head office. For remaining items, you need to apply conversion. Now the question says, closing stock on 31st March Sydney branch, Australian dollar 3125. This is closing stock, not a problem. Closing stock at closing rate. You are required to convert the trial balance into rupees. Use the following rate. Opening rate. Opening rate I will use for only one item. that is opening stock, opening rate for opening stock. Next line, closing rate, average rate, which approximates the actual exchange rate. So I will use average rate for all sale purchase item, and for fixed asset we will take 18 rupees when the fixed asset was purchased. When fixed asset were purchased, the rate was 18. Required, translate the branch trial balance if it is classified as integral, non-integral. Oh my god. Two times you have to solve. If it is classified as integral, how will you translate? And if you classify it as non-integral, then how are you going to translate? Okay. So we will solve one by one. I think the answer is there in your book. Just check. Please let me know whether the answer is given to you in your book. And this can be a part of your branch accounting topic, or this can be an independent question. So first we are following on the screen, we are following integral foreign branch operation rule. Integral foreign branch. In integral foreign branch, the non-monetary item for which we follow cost model will be valued using rate when they were acquired. So question should be continuously in front of you. When plant was acquired, plant and machinery, that is fixed asset, the rate was 18. So what the student will do, the student will see what is the value given in Australian dollar and multiply by 18. Check. Is this right? 18 into 200. 18 into 200, 3,600. And then accumulated depreciation on plant. Keep the whole question in front of you. Here also I am going to apply the same rate. Multiply 130 into 18. 130 into 18 is 2340. Debtor creditor are monetary item. Debtor creditor are monetary item. We will apply closing rate 24. 60 into 24. 60 into 24. Come on, 1440. Creditor is 30 Australian dollar. 30 into 24. 30 into 24, 720. Opening stock. Write in bracket opening. Opening rate. Opening stock will be at opening rate 20. And opening stock is 20 Australian dollar. 20 into 20. 400. Cash and bank is a monetary item. Closing rate. Monetary item closing rate 24 into 10, 240. Then purchase and sale average rate. Average rate. Purchase and sale average rate 22. 22 into purchase is how much? 20. 22 into 24, 40. Sale is 123. So 123 into 22. 123 into 22, 2706. Goods sent to branch, I will not use rate. I will take the contra figure from HO books. So in the note given below the trial balance, the goods sent by HO2 branch in rupees were 100,000. So just substitute the figure. Wages and salary will take average rate. Income or expense item average rate 22 into this is 45 990. Rent average rate 22 into 12 264. Office expenses, again average, 22 into 18, 396. Commission, again average. All these income and expense item average. Commission receipt means it is an income. 22 into 100, 2000. One more item, HO current account. This also I will not translate. I will apply HO books rate as per HO books, which is given below the trial balance is 120. Contra. This is contra and this is contra. Because branch is showing figures in dollar, same item is appearing in HO books in rupees. So now what the student will do, the student will check whether the total is tallying or not. And if the total is not tallying, it will give rise to exchange difference. It will give rise to exchange difference. And that exchange difference we will transfer to P&L account. So please tell me, what is the difference? Anybody, what is the difference? You're not responding. What is the difference? There is some exchange difference on the debit column. In order to tally, I have to put a number on the debit column, then only it will tally. So please answer. How much is foreign exchange difference? On the debit column, check. The difference on the debit side is 216. And now if you take the total, Sanket is right, the total is 8086. The total is 8086, and below the, so you can draw one line here to close the trial balance. Closing stock will come below the trial balance in information. Closing stock will be valued at closing rate. Closing stock will be valued at closing rate 24. Then we will say there is a closing stock of how much? 3125. 3125 into 24. 3125 into 24. You are writing in thousand, so 75. At the top, write down rupees in thousand. I think written in your book. Now there is a question, if current account is not given, what rate we will apply? It will be given to you because it's a branch account. So if there is a branch, there is a head office also. A branch cannot exist independently. Every branch should have a head office, so the amount will also appear in HO books. So it will be given to you. If they don't give you, it is a wrong question. So this is the answer for integral foreign operation. Okay, now we'll write down what will be the treatment of this 216. The answer is it will be transferred to P&L account. Okay, case 2. Case 2, branch is a non-integral foreign operation. If it is non-integral, all assets, all liabilities will be translated at closing rate. Second thing, exchange difference will be transferred to FCTR. Please try yourself now. Try yourself. Show to the world that you can do it. Okay. So now what we'll do, this plant and machinery will also be valued at closing rate. Oh my God. Plant and machinery will also be valued at closing rate. So you will take 200 into 24 now. It is non-integral. Everything at closing rate, asset and liability closing rate, assets and liabilities at closing rate, accumulated depreciation also 24. 24 into 130, 3120. Debtors and creditors, same figure copy from integral. No need to calculate again. Of course, opening stock will be at opening rate only because this was on opening date, not at the closing date. Cash and bank closing rate. Check the calculation. It is same. Just copy from previous answer. Purchase and sale. Same average rate. Goods sent to HO. Sorry, goods sent to branch. This is contra. Contra will be given to you in the question. As per HO 100. Wages and salary average rate 22. Rent average rate 264. Other expenses average rate 22. Commission receipt, keep checking the calculation, average rate 2200. HO current again contra. So the student has asked what if it is not given, it will be given to you. Otherwise, how the trial balance will tally, and this value will also be given to you, right? So don't worry. 120. Now you have to tell me whether it is tallying or not, and if it is not tallying, we will accumulate the difference in FCTR. We will accumulate the difference in FCTR. So who will tell me first? What is the FCTR account balance? Come on. What is the FCTR account balance? And whether it is in debit column or credit column? Come on, fast. Waiting for you. Show your calculation skill. So you will say the difference will come in credit column as FCTR, and it will remain here. It will not transfer to P&L account. It will be transferred to P&L account when the branch is closed. Credit side 204 is the difference, and the total of the trial balance, just check, 9070. Total of the trial balance is 9070. Yes, Tiwari is right. Sanket is right. And the closing stock, same closing rate 75. So this was a good example of same question solved by two ways, integral, non-integral, and a similar question is there in your branch accounting also. So question number 1 is over. Tanya is right. What is the treatment of this FCTR? FCTR will appear in reserve and surplus. FCTR will appear in reserve and surplus. After about 6 or 7 pages, you will find one question number 10. Please come to question number 10. Question number 10. After 5-6 pages, question number 10 is the account of a foreign branch is incorporated in the head office book. Like the previous problem, account of a foreign branch is incorporated in head office book at a standard rate. Standard rate means predetermined rate. Predetermined rate means budgeted rate, not as per market, but as per the pre-decided rate. And the resultant notional profit is credited. And whatever profit or loss that comes is credited to the head office profit and loss account. Comment. So this is wrong. accounting treatment. Sir, why it is a wrong accounting treatment? Because I never told you in the last three lectures, this is the third lecture right now going on, topic is lengthy, and if I use shortcut, you will not understand. And this topic is very useful for other topics also, and in your higher stages also. So standard rate cannot be used. Standard rate cannot be used. Standard rate cannot be used. You have to first check. You have to first check whether this foreign operation is integral or non-integral. Then apply the rule as per AS-11, as per AS-11 for converting the trial balance of foreign branch. So what this company has done is not in accordance with, is not in line with the principles given in AS-11. So these were the few questions on foreign operations. This chapter has three parts. First part, transaction in foreign currency, which we completed in the first and second lecture. Second part was foreign operation, which we completed today. Third part, which is a smaller part, is foreign exchange contract, forward contract. This we will continue tomorrow. This will continue tomorrow, forward contract. So, two or three questions I will take here. I will sincerely request, please solve all questions today except forward contract questions. This I will take in the next lecture, and then you can revise the whole chapter again. Thank you very much. Have a good day. Bye bye.